today, during this session, we're going to be talking about passive investing, right? Yes, the name of our company is passiveinvesting.com, but we're going to be talking about the 7 red flags for passive real estate investing. So this is a good talk for those of you who are obviously passively investing in various real estate syndications, but it's also good for those of you who are wanting to be an operator. And the reason why is because until you can realize what the LPs, the limited partners, are expecting, then it's going to be a little bit harder for you to be able to raise a significant amount of capital. So we're going to go through these 7 red flags. And for those of you who might not have been here this morning, see if this thing works. One of these days. Well, if you're in the back, there you go. Advance the slides. I'm not going to go through my background here again like I did this morning, but one thing I wanted to point out is my wife and I developed this list of these 7 red flags. It actually started out being only 5, and then we add flags to it as we go throughout our journey of investing. And the third one there, you can see it says LP positions in 57 different syndications with about 17 different operators. It's now closer to 60, might be a little bit more than that right now, but we have vetted quite a number of operators, and there's a lot of operators that we don't do business with, and of course we have a select number that we do also invest with. And so today I wanted to share with you 7 red flags, and these red flags are true red flags. They're not yellow, right? We're not talking about yellow flags where you just kind of look at this and it's like a cautionary, this is something that maybe we should consider, but we'll still move forward with our due diligence. If any of these 7 things I find when I'm doing due diligence on a new operator that I'm looking to invest with, I stop reviewing it and I move on. I don't continue to do any more due diligence on this particular operator. So the 7 things we're going to go over today, again, are helpful for you as a passive investor, but they're also helpful for you as an operator to be able to put together your own projects, right? And to make sure that when you're setting up your investor relations process, you have these things in mind. So the first thing we're going to go over today on the next slide, since this thing's not working, is the first red flag. The very first red flag is no successful background in business. And this is anybody that's on the operations team. We're going to talk about the team a little bit in a few slides here. But if there's nobody on the management team that has any sort of background in business, we were especially looking for a successful background in business, because we all know people who know how to run a business, but some people just run it into the ground, right? And we don't want to be investing with somebody who runs a business into the ground. And it doesn't mean that they can't have had a failed business in their past, but it's how they got up from that bad business, if you will, or the decisions that they made. How did they recover from it, right? But we want to make sure that there's somebody on the team that has some sort of successful background in business. And the reason why is because I know we're buying real estate, but when you're buying, let's just say, a multifamily property, you're really buying a business. You're buying a business that just so happens to have real estate associated with it. So you get the nice benefits of it being real estate. But you still have to know how to manage people. You still have to know how to put in systems and procedures and processes in place to be able to make sure that the person you are investing with, or your investors that you bring on, their investment is being monitored very closely, right? You have to make sure that you have those KPIs in place, and you know how to pivot whenever necessary, right? So maybe you're thinking, well, I want to be an active operator, but I don't really have a successful background in business. That's okay. Find somebody that you can partner with that can help fill the gaps of where you are lacking, right? One of the reasons why our 3 managing partners work really well together is because we all 3 have different skill sets, and they're complementary skill sets. And you need to find partners that have complementary skill sets so that you can actually move forward and grow, and you don't have to be butting heads because you guys want to do underwriting different ways, right? So if you want to find a successful or have a successful partnership, you have to find a partner that has those complementary skill sets than you. All right, number 2. I'm ready to get out of here. No. Number 2 is a part-time operator. And the reason why this is a red flag for me and my wife is we want to make sure that the hard-earned money that we have earned is being invested with somebody that is full-time in the business. And this is something that kind of rubs a few people the wrong way because there's a lot of coaches out there and gurus that tell you to start a side business or a side hustle. But I'm telling you right now, myself, I don't want to put money with you if you're treating my money as like a side hobby in a business that you're going to do on nights and weekends. It's not where I want my money invested, right? I want to make sure that's, okay, sure. Ooh, shot me. I want to make sure my money is invested with somebody who has full-time efforts watching my money day in and day out. And now being in the business, I realize how full-time it actually is, okay? Now, some of you might be thinking, well, then what do I do? I'm still working a 9-to-5 job. How do I get into this business if I can't do it on nights and weekends? You do it by not being the main operator, okay? You can still join and co-GP with somebody else, do some of the asset management, do some of the underwriting, do some of the property tours, do some of the asset management, but you're not the full-time person in the business. Until you get to the point of being able to be full-time in the business, that's how I believe you should start. Start off in a smaller role with a group, and unless you just want to burn the bridges, right? Like I know some people, they got enough money in reserves, they're willing to burn the bridges for 6 months and give it a try, right? If you can do that, I would say that's probably the better way to do it. But if you don't have the ability to do that, or you don't want to risk that for a 6-month, 9-month period of time, then I would suggest making sure that you are partnering up with somebody else, right? All right, next slide here. Part number 3 is only one managing partner. Now, I came up with this, my wife and I came up with this one because we were talking with I was actually in a small mastermind group up in New York City. And I was in New York City and I was sitting down in this mastermind and one of the gentlemen raised their hand and they said that they had invested $200,000 with an operator and he had brought his friend in and they invested $200,000. And then about 6 months into the deal, they can't find the operator. Don't know where they are. He's not responding. It was one person. They were a new operator. And the property was still there. They went and flew down and saw the property. The property management was there, but they wouldn't talk to them because they're just the limited partners. And no one could hear from this person. And so to me, I was like, you got to have at least 2 managing partners. Of course, my preference, because we have 3, would be to have at least 3, but no more than about 4 or 5. So once you get more than 5, then you just have too many cooks in the kitchen, right? But preferably 2 that are unrelated to each other. So it can't be a husband-wife. It has to be maybe a one family over here and another family over here, right? You can't have anybody that's related being the 2 managing partners. And if it is, it just means there has to be more partners, right? You can have 2 that are related, but now you can have at least 3. You want to have at least 2 people have to be unrelated to each other, because then you have the backup of, if this person goes ghost on me, I have at least 2 other people or 1 other person to go reach out to, right? And I think I might have mentioned this earlier, but if I didn't, one of the things that each one of the managing partners does in our offerings to our investors is we give them our personal cell phone numbers, we give them our personal direct emails, and we have that open line of communication with our investors. We want them to know that if they need us, they can reach out to us, right? So if one of us, doesn't respond, guess what? They can call the other partner, right? And they have that ability to have access to us whenever they want to have that access. Now, I don't know the full outcome of the story I was telling you earlier about how that ended up, but they ended up having to go through arbitration and go through the court process to be able to get access to the property. At this point in time, I don't think they even know what happened to the operator. I mean, it's possible that, he didn't run off with money, so he might have went on vacation in Cancun and fell off a cliff or something, hit a rock. Who knows? But when you only have one managing partner, you get left with stories like that where you don't really know, right? So that's one of our red flags. And as I'm going through these red flags, some of you might go, that's not a big deal to me. That's fine. These are my red flags, right? They're not yours. Now, you can actually take these and, of course, make them as your own. And I would suggest that you have a list of red flags that as you're going through the due diligence process and you're reviewing various syndicators' offering documents, that you actually ask these questions. Because some of these questions you won't actually know until you ask someone, or until you further review the documentation and you find some of these red flags that are actually present inside of the documents when you're reviewing them. Thank you, sir. Let's see if this works. Number 4. This is a biggie for us. It's no preferred return. So I'm a big believer in the preferred return. I prefer the preferred return, if I could say it that way. But if an offering doesn't have a preferred return, I just don't give it the time of day. I prefer that the operator give me, as the investor, the first fruits without what's called a GP catch-up, okay? Or if there's a preferred return, but they have a GP catch-up. So let me explain to you a little bit about what that is, for those of you who might not know what it is. First off, the preferred return is where the operator is saying 100% of the cash flows that come in off this property, I'm going to give to you 100% up to a certain number, right? 7, 8, 9, 10, whatever that percentage is. Then after that, we're going to have the equity splits come in. Now, that would be what that example I gave you was what is called a true preferred return, where there is no GP catch-up on the pref, right? But on a preferred return with catch-up, what happens is once you actually reach that 100% of the cash flows going to the investor up to, say, 7%, and then what happens before the equity splits occur, the operator goes back from the very beginning and says, we're going to catch us up as if we were doing a 70-30, 80-20, 60-40 split all along, right? Well, in the current environment, it's very hard to make a preferred return with catch-up work, and because it is very expensive. If you actually go through the modeling and you go 3 or 4 years without a catch-up, and now at the end you got to catch them up, a lot of the profits get sucked up by this preferred return with catch-up. So for us, we choose not to do that because I feel like right now, even though they might be able to make it work from the underwriting perspective, in the next 2 to 3 to 5 years, I don't think it's going to make sense. They're going to have a harder time doing that, and I don't want to give up most of my profits to an operator who's trying to siphon off the cash. All right, next one is number 5, modeling a refinance in the return projections. So when it comes to this, for the most part, I'm not a big fan of this. Lately, I've been softening it up a little bit with this, with a really deep value add, heavy CapEx plan. I can understand this making sense, okay? But for most run-of-the-mill, just standard value add or standard value add with high occupancy, to me, it just doesn't make any sense to model it into the return projections. And usually when you see a refinance modeled into the return projections, what you will also see is that they will also want to be doing they'll be doing no preferred return, or they'll be doing a preferred return with a catch-up. So all these kind of tie in together, because in order to make this make sense, you have to have a refi, because there's just not enough cash to set support on that investment or that particular asset unless you execute, you increase the NOI, you do a refinance, and then eventually you have a sale. The problem with this is that you don't have any opportunity or you don't really ever know what the modeling is going to look like in 2 years or 3 years when you're trying to do a refinance. You don't know what the interest rates are going to be. You don't know what kind of loan to value they're going to be offering you at that time. So it's very hard to underwrite it. And the only way to underwrite it is with the current environment. And we all know right now what's happening is not going to be the same as what's happening in 2 years or a year from now or by the end of this year, right? It's going to change. And so when you see a refinance modeled in, usually you will see some of these other red flags present. It usually comes up in multiple areas when it comes to these red flags. And another one that you'll see with the modeling of a refinance and the return projections is actually number 6. Number 6 is distributions as return of capital instead of return on capital. So when you're figuring out or you're laying out your as an active syndicator, as you're laying out your kind of waterfall, you can classify your returns, your distributions as giving investors their money back as return of capital or return on capital. This is an important one to kind of dissect a little bit here, because with the distributions as return of capital, what you're also doing is reducing the amount of preferred return that you're going to get. And the reason why is because whenever you have a return of capital, it's reducing what is called the unreturned capital contribution. So if you put in $100,000 and you got a return of $8,000, now your new unreturned capital balance is $92,000. And the preferred return is based off of the unreturned capital contribution. So if you're getting a 10% pref and you got 10,000 the first year, now you're going to get 9,000 the next year because it's going to be 90,000 the next year. So you're going to get 10% of 90,000 instead of 10% of 100,000. So you have a diminishing return of your preferred return whenever you have distributions as return of capital versus return on capital. Now, some operators that I've talked to will say, well, with the distributions as return of capital, it's more tax advantageous for the investor because it's money that they've already been taxed on, so when I give it back to them, they don't have to pay any taxes on it. And when you think about it, oh, yeah, that makes sense, except depreciation already lets me do that, right? So whenever I'm in an asset, depreciation is going to offset my distributions as return on capital, and I'm going to effectively be deferring those taxes as well, right? And at the end of the day, when you go to sell the asset, you're going to be made whole anyway, because whether you deferred taxes with depreciation or you decided to reduce your basis in the property because you're returning your capital back, at the end of the day, it's going to balance back out where you're going to still be paying taxes on that. So for me, the only way that this is beneficial is for the operator. The operator is really the only one who is benefiting from having distributions as return of capital. And one of the things that we do with our process for investor relations is we wanted to set up a process that allows our investors to know that we're there for them and to protect them, right? And our partners are the number one investors in our assets, so we're also LPs, right? We invest alongside of our investors, and so we're also protecting ourselves, right? So when we're setting things up, we want to make sure that our investors are successful, but we are as well. Because we're not the type of group that just wants to come in and raise capital on one deal and that's it, right? We want to be able to close multiple deals over multiple years and create a legacy wealth building play and tool for our investors. And the only way we can do that is if we're setting up our investor relations process to benefit the investors, especially on the front end, right? I don't mind as an LP if the operator has weighted it so that they have a large win on the back end, because that's what's going to incentivize them to continue to move forward and to continue to actually have more and more opportunity to be able to increase the returns. And if they get a great win at the end, fine. I'm fine with that, right? Our most recent car wash, express car wash waterfall really benefits us in the back end because we really think and believe in this asset class. And I'll just walk you through it real quick if you care to hear about it. But with the express car wash, we have a 10% preferred return. It's a true preferred return. And in that preferred return, it is, again, 100% of those cash flows goes to the investor, up to 10%. And then the equity splits come in. There's no catch-up. The equity splits come in, and it's a 60-40 split. So 60% for the LP, 40% for the GP. Once we get over a 20% hurdle, then it splits the opposite. It flip-flops. It goes 40-60. And then once we really outperform that asset and it goes above 30%, then it actually splits 10-90. So you can see we're still giving the benefit of the investor. The investors are still benefiting greatly, getting a 30% plus return if we hit those hurdles, but then we're also benefiting from the back end because we really want to outperform these assets and have a great kind of equity roll-up play once we get to 100 locations or more, or be able to do an IPO and have an even larger equity multiple, right? And so we believe in it. We feel like there's a great potential for it. And so we structured our waterfall in a way that we felt was still front-loading a lot of the benefit to the investors with the higher pref, especially during the hold period, and then also on the back end, slowly kind of flipping the tables, if you will, so that we as the operator have a larger benefit once the return gets above 30%, okay? I think I might have had one or maybe two investors that have reached out to me asking about that, and once they understood kind of what our thought process was on it, it made sense to them, right? It made sense to them that it's fine. Like how many of you would be fine to put in $100,000 to a deal and making 30% IRR on that deal, right? I mean, everybody in here should be raising their hand, right? Now, obviously, you want to do 60% if you can, but I mean, 30% is not bad. And we truly believe in that asset class. So when it comes to the return of versus on, the only way you're going to find this information is by reviewing the documents. You have to review those documents very carefully because this is not something that you're going to hear on a webinar where they're going to say, we're going to be doing all of your distributions as return of capital versus return on. They're not going to bring it up. I mean, we don't bring it up on our webinars, right? But it's inside of the documents, and you have to look at it. And the crazy thing is that's only one letter different, and it makes a big difference. So return of versus on, it can really change the dynamics of a particular deal, and that's why when you go back to number 5, modeling of a refinance, you're going to likely see really high fees. You're going to see the redistributions as return of capital, and then you're also going to see a potential preferred return with a GP catch-up, right? Or just no preferred return at all. So when you're going through these are all kind of overlapping. And I would say probably the biggest one that you will look for is the refinance. And again, they don't usually talk about that in the business plan either on some of these webinars. You sometimes have to dig or even ask. Like, let me see your underwriting, or can you just tell me if you are modeling a refinance into your projections, and at what point during the modeling does it kick in? Is it 12 months down the road, 18 months, 24, 36? What does that down the road refinance look like? And that way you can have a better idea as to when you're investing with this operator where the actual refinance is, and because the farther down the road it is, the more unreliable it is, right? But this refinance one is one that if you see that, you're going to probably see multiple ones of these red flags that are present. Now, number seven is no skin in the game. And this is one where every deal that we've put together, all 3 of our managing partners have invested alongside our investors in every single one of the deals. And some of you who are first getting started might think, well, how can I invest if I don't have any money, right? That's a problem. You got to be able to have some money in order to invest. But when you're putting these deals together in the very beginning, what can you do? You can reinvest some of your fees that you're getting off the deal, right? And that way you're able to tell the investors that you are investing alongside them. Now, I prefer to see an investor investing at least $100,000 or more inside of each one of the investments. And sometimes the fees might not be that high, depending on the size of the deal, especially as you're getting started. But again, these are my red flags. Doesn't mean that everybody's going to say no to you because you didn't put in $100,000. That's just a criteria that my wife and I have, that we want to see the investors co-investing with us at least $100,000 or more, okay? And the reason why this is an important one is because investors or operators that are not investing alongside of their investors are probably not well capitalized enough. And again, I'm talking to you from the LP's perspective, so you can kind of see what an LP thinks when they're trying to invest money in an operator. If that operator doesn't have enough money to put skin in the game on this deal, number one, they either don't believe in the deal, and they're just trying to shove this down my throat as an LP, and hopefully they'll get enough money to close it, or number two, they are undercapitalized, right? They just don't have enough money. And what we have done from the very beginning is made sure that we were well capitalized in the deals that we have coming in. And it's not just from the deals themselves, but also as the 3 managing partners are well capitalized as well. So if for some reason a property starts to not perform, instead of doing a capital call, maybe we can do a 0% interest loan to the property to be able to get them on their feet again, right? Or if we underestimated how much it was going to cost for CapEx, we need to give the property a 0% interest loan, we can do that as well. Now, in our operating agreements, it does say that we can charge an interest rate on there, but we just have made the decision, if we have to do that, we're not going to charge interest. Because I never want an investor to think that we purposely underestimate our CapEx just so that we can get interest off the money that we need to put it up as a loan. And so we just choose not to do that at all. We just charge, it's just a 0% interest if for some reason we have to do that. And there's been 1 or 2 properties where we underestimated the CapEx and we had to put up some more money. But if we didn't, we wouldn't have been able to perform the way we would have performed and outperformed our projections. And so we were able to put some additional money in, and it allowed us to be able to do that. And so an investor who has no skin in the game has no incentive other than their reputation, obviously, to be able to make sure that deal performs, right? Now, obviously, if the deal doesn't perform, then there is incentive there of like, if this deal doesn't perform, then I'm going to have a bad rap and no one's going to want to invest with me, right? And so having that skin in the game definitely allows the operator to have an alignment of interest, if you will, with the investors, okay? So let me go back a couple more here. So when we go back to this list again, one of the things I wanted to point out to you is kind of how to find out information about each one of these red flags. So number one is probably the hardest to find out. Because if you ask anybody in business, are you a successful business person, what are they going to say? I'm not going to tell you that they're a bad business person, right? So, and then if you ask for referrals, what are they going to do? They're going to send you referrals of people that are going to tell you that they are a good business person. So it's very hard to really get a objective assessment as to whether or not they have a successful background in business. But what you can do is you can ask them, well, tell me about the businesses that you've owned and tell me about the businesses that you say that you have a successful background in. And then guess what you can go do? Go do research on those companies. You can pull them up online and figure out kind of what's been the success and the track record of that particular business. Are there any pending lawsuits out there for that business? Are there any bad reviews out there from customers or clients or patients or whoever their clientele might be? But this one is definitely one of the hardest ones to really figure that out. Of course, the next one here, number 2, part-time operator, that's pretty easy, right? You just ask them, hey, are you the only one in the business? Are you full-time? Are you part-time? I also like to ask, how many full-time people do you have working? And how many people do you have that are part-time? Because I've seen some teams, I've even seen people on this stage, not this weekend, but in years past, I've talked about, I got 50 people on my team, and they're all 50 part-time virtual assistants all across the world, right? But I want to know specifically how many full-time people and how many part-time people do you actually have working that are on your payroll, not property management, right? We have right now around, I think last time I counted was 31 full-time people that are working full-time in our business, and they're all stateside, at least now they are. We had one that worked in Spain. I'm not sure where he is, but he worked remotely in Spain with us for a short period of time before he moved back here into the States. We have 31 people full-time that are working for us, and they're watching the investments every single day, right? We want to make sure that we have that full-time team in the background that is actually watching the investments and not just a part-time operator that is doing nights and weekends. Now, I will tell you, when we go back to the other one, the earlier one we just did, which is about the successful background in business, I'll have people that will ask me, well, do you spread your time between your other businesses and the real estate? Because they're asking the right question of how vested are you in making sure that the real estate side of what you're doing is actually successful. And I always tell them, listen, 95% plus of my time is in the real estate. And in this private equity real estate firm, you can ask any of my team members that of the involvement that I have, but I still have a corporate directors meeting with my medical clinics and some of my other businesses. I have a corporate meeting with them once a month to go over the KPIs, go over the metrics, make sure that the business plan is actually performing the way we want it to perform, and if not, I'm there to provide additional advice and support and guidance, right? But I'm not going into the clinics all day long and seeing patients and dealing with that. I'm not doing that. I haven't done it in probably 5 or 6 years now. I haven't actually been full-time in the clinics. I stepped out and have a good team that supports us. I have another probably 40 plus people that work for us as full-time employees in the medical clinics as well. Now, as far as one managing partner, this is another easy one as far as trying to find out about this. Again, asking them. And a lot of times you can just look at the documents. If you look at the investor OM that comes out, the marketing kind of pitch deck, it usually will list in there who the operators are. And then it'll also, inside of the PPM, the private placement memorandum, inside the operating agreement, inside of the investor questionnaires and the documents and stuff like that, it'll list out who those operators are. And so you can look at their documents, but you can always ask them as well, right? And when you're asking about the managing partners, ask about whether or not they're full-time or not, okay? They might have some part-time managing partners, which is, I don't think there's anything wrong with that. You could have part-time managing partners as long as you have somebody who's full-time in the business, right? You want to make sure that you have that person who is full-time in the business. The next one here is the red flag number 4, which is the preferred returns. When it comes to these are probably, they're fairly easy to find as long as you know what you're looking for, but most of this information is going to be in the waterfall. So there are usually 3 different waterfalls Most people probably have two, but there are three potential waterfalls that you can have in a deal. You can have what is called the cash flow waterfall, which is what happens to all the cash that's being spun off this investment. What happens to it? When it goes down the different buckets, and the best way I explain a waterfall is if you think of it as buckets of like, not water right here, obviously it's a waterfall, but cash, right? So you have a bucket up here, you have a bucket down here, and you have a bucket down here. And the hurdles are what makes the bucket overflow into the next bucket. So the 7% preferred return is going to be over here. All the cash as it comes in is going to go into this first bucket. It's going to fill up until it reaches that first hurdle, which is the preferred return hurdle of, say, 7%. And what's going to happen? The cash is going to spill over to the next bucket. And this next bucket might be the 70-30 split up to a certain IRR level. Let's just say a 13 IRR. So if that cash continues to fill up that bucket, going 70% to the LP, 30% to the GP, up to that next hurdle, which is that 13 IRR, then it's going to spill over into the next bucket. And you can see as you're building out a waterfall how that actually works and how all the cash flows. So a cash flow waterfall is basically saying the cash that comes in, what are we going to do with it? So you have to make sure, that's one of the first things I look at when I get a PPM. I just pull up the search bar and type in distributions. I go to the distribution waterfall, and it's the first thing I look for is what does their waterfall look like? And so the first one that you're going to look at is the cash flow waterfall. The second waterfall you're going to look at is what is called the capital event or the refinance waterfall. Sometimes people will combine two of these into one, calling it just a straight capital event waterfall, whether it be a disposition where you're selling the asset or whether it be a refinance or a supplemental loan. They call it a capital event waterfall. So, but they can also split it up. Like some of our investments, we actually have three different waterfalls where there's a refinance or a supplemental loan waterfall, and then there's also a separate waterfall called a capital event or a sale waterfall. But basically what's happening at the end down there with that is that if you do a refinance or you do a supplemental loan and you have cash that comes in, that cash, what's happening to it? And so in the waterfall, it's usually written out, right? So it's going to say first, we're going to pay this. Second, we're going to pay this. Third, we're going to pay this, right? And it'll explain to you the entire waterfall process of what they're going to do with that cash when it comes in whenever you do a refinance or when you actually sell the property. But one of the very first things, like I said, I'm going to look for in a PPM is this right here, because it's very easy to spot. If you look at their waterfall, they're required to disclose this to you. They don't necessarily have to tell you on a webinar when they're introducing the property, but they do have to disclose anything that they're trying to do on the property with a waterfall, whether it be any types of fees or anything like that. You want to make sure that you look at that. And the best way to do it is just to pull up the PDF document of the PPM and just search. Just search for distributions, and it'll come straight to a waterfall, and it'll say, it doesn't always say waterfall, but it might say, distributions of cash flow or distributions at a capital event. It'll be usually a bolded list of this is what's going to happen, this and this and this, and it goes throughout that process so that you as the investor fully understand what's going to happen to the cash, right? Because you want to make sure that the cash when it comes in is being dispersed the way you want, and you want to make sure that there's not any of this kind of I call it shenanigans happening in the waterfall. Now, I will tell you that I've reviewed some waterfalls with some investments that I've been in, and I've reached out to the operator and I said, do you realize that this is saying that your distributions are return of capital instead of return on capital? And they go back and they're like, no, it's supposed to be return on capital. I'm like, well, you need to go look at your PPM because it's not written that way. And they'll go back, review it, and they'll go, yep, we just didn't catch that, and they'll fix it, right? So it doesn't necessarily mean if you see some of this stuff that you shouldn't bring it up. Like every operator that I've ever said no to, I've told them why, right? I don't want them to think that I'm just going to say no after I do a soft commit. If I do a soft commit and I end up not investing, I'll tell them why. And I'm just very upfront and direct with them. You have a preferred return with GP catch-up, and I think that's too rich, and that's one of our red flags, and we don't invest. Okay, that makes sense, right? So whatever operator you're investing with, I would highly recommend always having that open communication and dialogue with them, because a lot of times they don't even know sometimes that this stuff is in there because they get their documents from their attorney, and if they're not fully reviewing their documents, because, I mean, hey, we've made mistakes before on our PPMs before, right? It happens. Matter of fact, one of our most recent investments we made a mistake on, and it wasn't necessarily that it changed the dynamics in the actual PPM, but in one area it had language to support it in one way and language in another area to support it in a different way. And so we had to make sure we changed and modified that PPM to be consistent across both the actual operating agreement and the rest of the disclosure documents that were actually inside of the offering documents. We talked about this one earlier, modeling a refinance and the return projections. The best way to find this is just to ask either for the underwriting or to just ask the operator, are you guys modeling this? That's the best thing you can do to be able to get this information, because even if you're not really versed in reviewing underwriting, a lot of times some of this kind of stuff can be hidden and it's kind of hard to find. But if you're really good with underwriting and you want to look at it in more detail, hopefully the operator will give you a copy of the underwriting so that you can review it, right? Or at the very least, give you a copy of maybe the T12 and the rent roll, and you can go and underwrite the deal yourself, right? You can do it either way. And same thing when you talked about the return of capital versus on capital. This is exactly what you have to do inside of the offering documents. You have to just review those PPMs and make sure that inside of those PPM documents, you have read them carefully, because again, this is only one letter difference between return of capital versus return on capital, and it can make a dramatic difference in the returns for your particular investment that you're investing in. And same thing from you as the operators. This is going to be a great benefit to you, but it's not to your investors. So you have to think about that. Every additional fee that you charge investors, or every additional piece like this that you charge investors, is taking away the return from the investors and is putting it in your pocket, which may be great in the short term, but if you want to grow and you want to scale, you have to make sure that you set up your investor relations process to really be a benefit and be successful for your investors, right? One of the things that we have always told investors is, if we have an investment that doesn't perform very well, one of the nice things I like about these types of investments that we're putting together is normally we're going to have some sort of equity split, right? Most common is a 70-30 split. Well, we look at that and go, that means we have a 30% buffer in this investment, in the actual underwriting, that if we need to give up some of our 30% to make sure our investors are made whole or get the returns that we're projecting, we can do that, right? Thankfully, we haven't had to give that up, but if we like that kind of fail-safe, if you will, to be able to give up that 30% if we need to, right? And so that's something that I actually have seen other operators do, but I also think from an investor's perspective, it's really great because the investors see that, right? One of the other things that we see is, I lost my train of thought on that last one, but we see a lot of things, you know. But anyway, let's go back to this last one here. We'll wrap things up here. So the no skin in the game of the operator, this is probably one of the harder ones to review as well, because, you know, we get investors that ask us all the time, you're like, how much are you putting in that next deal? And we'll tell them we're putting in, 10%, or we're putting in, 1.5, or whatever the investment amount is. And it's like, well, how do I verify that you actually put that amount in, right? We've actually had investors ask us, and we're like, I'm not really sure how to explain it to you other than I can show you my wire, because we always wire in the money, right? So I can show you my wire, how I went in from my personal checking account or my holdings account and into the operating account. That's the only way we can really prove to them that's what it is. But hopefully the operator that you're investing with, you trust them enough that when they tell you that they're investing $1.5 million or whatever the amount is, that they're actually going to invest that amount, right? I don't think we've ever had an investor that, I think we've had like maybe one or two, Andrew, have actually asked us for proof, I guess, if we've actually invested that. But just sending them, I guess, a copy or a screenshot of the wire has been the best way to do that. But you definitely want to make sure that in the investments that you're investing in, that you have an operator that has skin in the game and a significant amount, right? And so, significant to, you might be significant to be different than you over here, right? That significance is different. If you're new, $25,000 is a significant amount of money. If you've been in the business for 3 to 5 years and we know you've had a lot of great successful exits, $25,000 is probably not going to be a game changer for you, right? So it needs to be more than that, more than 100 too, more than 100,000, right? Our goal with our group is to try to invest at least 5 to 10%, as close to 10% as possible, but at least 5 to 10% of the initial equity that has to be put into the deal. Most of the time, the reason why we can't do it is because the investors are filling up the investment first before we can actually fill it up, right? But we always want to make sure we reserve that 5 to 10% for our investors. Well, that's all I have for today, so let me go ahead and give you this last slide again. I know some of you have already connected with me on LinkedIn. I saw quite a few requests come in. If you want to scan this with your phone, it'll bring you straight to my LinkedIn page, and you can certainly connect with me further, follow some of our content, and thank you so much for having me, and I hope you guys have a good rest of the afternoon.